with everything going on with the trade war and now with Hong Kong and maybe yesterday with Argentina, Larry, I feel like if that wasn't happening, European banks would probably be our top story every day.
Well, you know, we have to look at the world over the last 6 years. We've seen kind of market-friendly, populist governments come into the fold. Argentina is a perfect example, Mr. Macri. And, you know, now you're seeing a transition over to the left wing where there are market-hostile governments coming in. And if that's a trend through Latin America, and now we have that risk in America itself, right? It won't be the same type of credit risk, but you know, all you need for equities to have a real problem in the United States is the probability of a left-wing market foe government coming in to the United States or other countries around the world, and then equities have to reprice really quickly.
How worried are you about? Here's the problem with European banks. Equity doesn't always tell the story. We'd like to think the stock market tells the story. It does to a point. The stocks of these banks have been terrible. I mean, Commerzbank, Deutsche Bank, UniCredit, sort of the big three, their stocks are at or near all-time lows. Do you feel like the stock market is adequately or maybe overreacting to the real health or lack of health of these banks?
Well, here's a case where the EUFN, which is an ETF that owns a lot of these European banks, has been pricing in credit risk, what's called a cram down. In a capital structure, say in a bank, you've got debt and equity. And that equity value of that pie has been crammed down and crammed down and crammed down for, you know, going on 6, 7 years. This bear case is the most prevalent, well-known bear case, I think, in the history of capital markets. So you want to be buying things like European banks down here. Sure, you've got some more downside, but if you accumulate European banks over the next, say, 6 to 9 months and hold them for, say, 2, 3 years, you're going to be in a very, very good spot.
Well, why are you so why are you so confident in that, Larry? Because they've just gone down, down, down.
I'll tell you why. Because the European governments, especially in the north, have been smoking in the dynamite shed. They've been sitting back and watching Mario Draghi fire bullet after bullet after bullet, blank after blank after blank, destroying these banks. Okay, negative yields on almost 100% of German bonds, 100% of Denmark bonds. I mean, this is absolute insanity. They have to sit back and do a fiscal plan, which they will do in the next 6 months, lay off the central banks, lay off negative yields, and then you're going to see once that beach ball, which is pressuring these banks, this negative yield overdose, once that reverses itself over the next 6 months, because you're going to see a fiscal plan in the UK, fiscal plan in Germany, fiscal plan that'll revive these economies, these banks will soar in a massive counter-trend rally.
A bullish view on European banks, something we have not heard of, Larry. You were on the tape. Let me ask you this. Let's switch down to the southern hemisphere, okay? Argentina, second biggest decline, one-day decline, in the history of any modern stock market ever. Oh, now, there is a 100-year bond that was sold, a couple of 100-year bond. It yielded 7.9% when it was sold. With the drop yesterday, it's over about 54 cents to the dollar. I think the yield on that bond, and correct me if I'm wrong, is now around 12%. Everyone's desperate for yield. Would you take a flyer and buy that Argentinian bond to try to get 12% on your money?
Well, think about this. The bond's gone from like 85 cents a dollar when it was issued to now 50. So you're talking about 30-point loss across all the debt in Argentina. You're talking about close to $50 billion of losses this week. And I wouldn't touch that bond because I don't trust Christina and Mr. Fernandez, Kirchner, that government. I think, though, overall, there are some places in the bond market globally that you can look at. But net, like you said, there's too much money that's been crammed into negative yielding bonds, and that has dislocated the credit risk of many, many governments. So, in other words, 2 weeks ago, 3 weeks ago, people were piling into this 100-year bond, and now as you see left-wingers coming in, left-wing risk, now the money's flying out as fast as it came in.